Aloha, I'm Carl Bonham, the Executive Director at UHERO. I'm here with another UHERO Focus Update, this time for our second quarter forecast report. And, just 3 months ago, we were sort of optimistically looking forward to some continued growth as we came out of a weak 2025. And then, of course, we get hit by multiple Kona low storms and now a war with Iran. So let's go ahead and look and see where we've been. And then we'll talk about the shock from the war. 2025, admittedly, was a pretty lousy start. Net job creation, the gold line in the bottom panel here, peaked at about 1,000 jobs per month in the beginning of the year and fell into negative territory. So we were losing jobs throughout the first half of the year. And then we began to see growth really on the back of very strong visitor spending in the second half of 2025 that led us to be sort of cautiously optimistic about 2026. We were also looking forward to some of the fiscal stimulus, the tax refunds, et cetera, coming in 2026. But the start of the year, notice that the last data point here for the gold line net job creation is basically at zero. And actually the March payroll jobs number for the month of March in 2026 is lower than it was in January of 2025. Basically, and that data point would have been impacted by the Kona low storms that disrupted lives and the economy and destroyed properties, et cetera. Of course, now we're dealing with a supply shock that is going to drive up costs. No one can tell you exactly when this war will end or when the strait will reopen or gas prices will come down. And so we're doing a set of scenarios. We've got a baseline scenario that is maybe even a little bit on the optimistic side. And you can think of that as, okay, the strait reopens in the next month or so. Oil starts to flow again. It gets to markets over the next 6 weeks or so, and refined products start to get out within the next couple of months. And then you begin to see prices come down. So that has Brent oil prices, these are spot prices, not future prices, hovering around $120 a barrel in Q2. And then coming down pretty rapidly, falling below $90 a barrel by the start of next year, and then remaining in that area around 2027 and into 2028. In the pessimistic scenario, this is where the war is prolonged, the strait remains closed for maybe into July, maybe even late July or August. And in that case, oil prices have to rise to reduce demand for oil because really, what we've been doing is consuming out of inventories, and there's a limit to that. And the oil price rise here in this scenario reaches $170 a barrel for the quarter and remains elevated over $100 a barrel in the out quarters. So what does that do to the U.S. economy? Well, the baseline scenario is one that the U.S. economy can weather. It brings the right chart shows U.S. real GDP growth, and the green bars are our forecast from our first quarter forecast report. So 2.2% in 2026. Our new baseline forecast brings that down to 1.6%, 1.7%. And so, we're talking about a 40 to 50 basis point cut in the forecast. And then bouncing back and sort of converging on trend growth. The pessimistic forecast is quite a bit harder. Initially, that higher oil price, higher gas price. So think gas prices $5 plus a gallon nationally. I know that doesn't sound like much in Hawaii, but nationally, those are big increases. That really eats into overall consumer spending. Consumers that are spending 20, 30% of their income, this is low-income consumers on energy, have to cut back elsewhere. And U.S. real GDP growth, instead of being 2.1, 2.2, is 1%. So, a full percentage point, a little bit more than that cut to GDP growth, and then a bounce back going forward with GDP growth getting back to trend in 28, 29. And, why do I spend so much time focusing on the U.S. economy? Well, it's driving Hawaii's economy, everything from federal spending and tax policy and monetary policy, but more importantly is visitor spending. 80% of the visitors in Hawaii are coming from the U.S., and 80% of visitor spending is relying on U.S. And if you see that peak in real visitor spending in the fourth quarter of 2025, in this chart, the green line is real visitor spending, and then 2026 first quarter remains elevated. That's a 6% year-over-year growth in real visitor spending in Q1. In the baseline, and this is our baseline forecast, we have visitor spending continuing to decline all the way to first quarter 2027, when the U.S. economy begins to grow more rapidly, and oil prices come down and gas prices come down in that baseline scenario. And so, this is something that Hawaii can weather. The size of this drop is a little bit smaller than the post-Maui wildfire drop. Of course, this is the baseline. In the pessimistic scenario, it's a completely different story, and visitor spending would be impacted much more severely because consumers across the world are spending so much money on energy to cool their homes or heat their homes and to get food on their table, that they're cutting back on sort of non-essential spending. If you look more closely at what that does to Hawaii in terms of inflation, that's the left set of bars here. And again, the green bars are our first quarter forecast. We had forecast inflation to be just a little under 3% in 2026. In the baseline, we think that jumps to 4.2%. And in the pessimistic scenario, we think that jumps to closer to 5%. They all come back down eventually as energy costs come down. In the pessimistic case, it takes longer. And so the hit particularly to middle income and below households is much, much larger in the pessimistic case. So what about Hawaii's overall economic growth, Hawaii real GDP growth? Our forecast coming into this before the Kona lows and before the oil price shock was almost trend growth. So 1.7%, 1.6% real GDP growth for Hawaii. We think that'll be a full 60 basis points or down to 1% in the baseline case. So again, that's something that we can sort of manage. It's not necessarily a recession. The pessimistic case is almost certainly a recession for Hawaii, with real GDP growth just a little bit above 0.3, 0.4% in 2026. And then in the pessimistic case, it takes longer to recover, but you do eventually bounce back and get back to roughly 1.5, 1.6% real GDP growth, which is about all you can expect in an economy that's not adding population or labor force. And so, let's hope that our forecast is too pessimistic and we get through this. The weather gets better, just like it did after the Kona storms, and we get through this economic turmoil once again. Mahalo.